Good evening, and welcome to the Crypto Overnighter. I'm Nicodemus, and I will be your host as we take a look at the latest cryptocurrency news and analysis. So sit back, relax, and let's get started. And remember, none of this is financial advice. And it's 10 p.m. on a Friday, June 2nd, 2023. And welcome back to the Crypto Overnighter, where we have no sponsors, no hidden agenda, and no BS. But we do have the news, so let's take a look at that. The U.S. Commodity Futures Trading Commission proposed an overhaul of its rules for risk management. Commissioner Christy Goldsmith Romero emphasized the importance of firms being prepared for the volatility of cryptocurrencies as well as the risks associated with holding customers' digital assets. In a statement, Romero mentioned that technological advancements like digital assets, artificial intelligence, and cloud services have introduced significant risks that require a reassessment of regulatory oversight and risk management requirements. One key area of concern highlighted by Romero is the integration of digital assets with banks and brokers. She acknowledged that this integration is an evolving landscape that could bring new risks. The CFTC recognizes the need to revisit its regulatory oversight in light of these developments. Additionally, Romero raised concerns about the custody practices within the industry. Brokers may explore holding customer property in the form of stablecoins or other digital assets. This practice introduces unknown and unique risks to be addressed. To facilitate public input, the CFTC issued a, quote, advanced notice of proposed rulemaking. This notice serves as the preliminary stage of the rule process. It allows for public comments and feedback. A formal proposed rule will be presented after this comment period, and a final version will be voted upon. The CFTC's proposal aims to address the challenges and risks posed by technological advancements, specifically in the realm of digital assets. By seeking public input, the Commission aims to ensure that its regulatory framework remains effective and responsive to the evolving landscape of the financial industry. Now, speaking of regulatory changes, let's turn our attention to a bank that's been a key player in the crypto industry. Silvergate Bank has reached an agreement with the Federal Reserve to submit a self-liquidation plan to California financial regulators within the next 10 days. The Federal Reserve's Board of Governors made this announcement as part of their process to wind down the operations of the crypto-friendly bank in California. The bank is required to preserve cash and other resources to ensure that their depositors are fully compensated. The California Department of Financial Protection and Innovation must approve the plan to liquidate the bank's assets. There is a possibility of extending the deadline for this plan. In March, Silvergate announced its decision to cease operations. Now, according to the Federal Reserve order, a recent examination conducted by state regulators and officials from the Federal Reserve Bank of San Francisco revealed several deficiencies related to the bank's compliance with banking laws and regulations, as well as its safety and soundness. The bank's failure was attributed to its dealings with the now-defunct crypto exchange FTX. Silvergate Bank did manage to survive the collapse of FTX and a significant write-down on Diem. Diem was a digital asset linked to Facebook at one point in time. It's dead now. Silvergate was able to survive, albeit temporarily, by securing a controversial emergency loan worth billions of dollars from the Federal Home Loan Bank of San Francisco. The government created the FHLB to support mortgage borrowing in the United States. It was their funding that provided temporary relief to Silvergate Bank. The Federal Reserve stated that the bank experienced a significant decrease in deposits from its customers in the crypto asset industry, primarily due to the collapse of FTX and Alameda Research. Well, that and Silvergate's business strategy that was tied to the digital asset industry. And there was a bank run that had implications for both Silicon Valley Bank and Signature Banks as well. This resulted in funding and liquidity challenges and a decline in revenue-generating activities. This announcement from the Federal Reserve highlights that Silvergate's leadership did not challenge the enforcement action. As part of the order, any senior executives' bonuses, promotions, or severance payments must receive regulatory approval. The Federal Reserve has the authority to intervene in the case of state-chartered banks like Silvergate if they're part of the central bank's system where it acts as the lender of last resort. Now, while Silvergate is winding down, other players in the crypto industry are facing their own legal challenges. Digital Currency Group and its CEO Barry Silbert have requested the consolidation of two class action lawsuits related to alleged losses during the crypto winter. They argued that both cases share the same facts, legal issues, and class definitions. Consolidating the cases would prevent conflicting decisions and promote efficiency. The defendants informed the judge that they had asked for the case to be transferred from New York to Connecticut and planned to move quickly to consolidate both actions if that transfer is granted. However, the plaintiffs in Connecticut contested the move. They said that it's premature to decide on this case before the case in New York is approved for transfer. They're also expecting opposition from the New York plaintiffs due to uncertainty in the nature and scope of those claims. The lawsuit in Connecticut accuses Silbert of orchestrating a misleading transaction to hide a $1.1 billion implosion after 3AC went under. The defendants are accused of securities fraud for making false or misleading statements. In the midst of these lawsuits, DCG has decided to close down its prime brokerage subsidiary, TradeBlock. TradeBlock began the process of shutting down on May 31st. The firm cited the state of the broader economy and the uncertain regulatory environment for cryptocurrencies in the United States as their reasons for the closure. Now, amidst these legal battles, some companies are making strategic moves to stay ahead in the crypto game. Circle announced it would launch a new native version of its USDC stablecoin on the Arbitrum network on June 8th. The existing version is currently based on Ethereum and is bridged to Arbitrum. It will be replaced with a native token that operates directly on the Arbitrum network. This new version of USDC will be recognized within the Arbitrum ecosystem. It will eventually replace the bridged version from Ethereum. So, to differentiate between the two versions, Circle plans to rename the Ethereum-based version as USDC.E, and the new Arbitrum version will just be USDC. The primary objective of this initiative is to enhance transaction speed. They plan to do so by utilizing cross-chain transfer protocols, or CCTPs. They're protocols that facilitate the transfer of assets between different blockchains, enabling users to consolidate liquidity and to support various crypto and Web3 assets in their various portfolios. By leveraging CCTPs, USDC will be able to move seamlessly between Ethereum and other supported chains in a matter of minutes, eliminating withdrawal delays. The decision to make these changes to USDC comes at a time when the stablecoin market has experienced a negative trend over the last year. Circle has also faced a decline in its market share during this period, with USDC's market cap dropping from $55 billion to $29 billion. However, Tether has been an exception to this trend. Tether's USDT stablecoin has seen its market share rise from 47.04% in 2022 to 65.89% in 2023, with the market cap surpassing $83 billion. Now, as Circle adapts to its changing landscape, let's shift our focus to the international scene where Qatar faces criticism from a global watchdog. The Financial Action Task Force is a global anti-money laundering watchdog. While the FATF criticized Qatar for taking little action against cryptocurrency companies that have violated a 2019 ban, the report urged the Qatar Central Bank to proactively identify and sanction virtual asset service providers that breached their crypto prohibitions. The report accuses Qatar of being too lax on terrorist fundraising. They say that Qatar has yet to demonstrate proactive enforcement announced by the Qatar Financial Center Regulatory Authority in 2019. The report did mention that 2007 transactions were rejected and 43 accounts were closed due to digital asset links. That's not why they're upset. The FATF is upset because, as they say it, no formal sanctions have been applied to individuals or entities for contravening the prohibition. And they said an unlicensed crypto provider was allegedly operating in the country. The FATF also highlighted significant inconsistencies between Qatar's risk profile and the prosecution and conviction of terrorist financing activities. As we've discussed, the FATF aims to monitor and mitigate dirty money flows. One of their tools is the controversial travel rule that requires identifying participants in crypto transactions. Now, while Qatar is not as crypto-friendly as its neighboring country, the UAE, the governor of Qatar's central bank has acknowledged the potential benefits of faster payments and mentioned that the bank is exploring the possibility of a digital rial, which would mark their entry into the world of central bank digital currencies and all that sweet financial control and surveillance over their citizens that such technology affords. But I digress. The Qatar Central Bank issued a statement on its website in response to the FATF report. They said that the assessment demonstrated the country's commitment to combating illicit financing. The statement emphasized that Qatar continues to improve and strengthen its system to do so based on international standards. Now, while Qatar grapples with the FATF's criticism, China is making strides in setting standards for blockchain technology. China's Ministry of Industry and Information Technology has recently introduced a new national standard. This standard covers the development of blockchain technology in the country. The aim is to regulate and streamline the use of blockchain technology in China. They will also be looking at ways to expedite its progress. Now, while China has been predominantly unfriendly towards cryptocurrencies, even imposing a ban in 2021, the country has shown an active interest in exploring the potential of blockchain technology. And remember, they are different. You don't have to have cryptocurrency just because you have a blockchain. That's why the ministry recognizes it as a crucial component for the advancement of China's digital economy. One notable application of blockchain technology in China is the development of the digital yuan. That's their central bank digital currency. CBDCs are all the rage in authoritarian governments these days. Now, China has made significant strides in this area, launching their first CBDC wallet dispenser earlier this year. However, the initial response to the digital yuan has been underwhelming, which is also true for the e-naira in Nigeria. So that's a thing. Several countries worldwide are taking substantial steps towards regulating and utilizing blockchain technology and digital assets. Hong Kong, for instance, has implemented new regulations that enable retail investors to access digital assets. In the European Union, the Markets in Crypto Assets framework garnered praise, and it's been adopted by both the European Parliament and the European Commission. Now, although the United States faces criticism for its delayed approach to blockchain-related legislation, progress has been made to address these concerns. In September 2022, the White House introduced its first framework for developing digital assets. Additionally, this year witnessed the establishment of the Subcommittee on Digital Assets, Financial Technology, and Inclusion, demonstrating a commitment to addressing the shortcomings in this area. As China sets new standards, Singapore is tightening rules around stablecoins. The Monetary Authority of Singapore recently released a notice urging companies that offer crypto-related services to enhance their customer due diligence procedures. The financial watchdog requests more comprehensive information regarding accounts and transactions, e-money transfers, and high-risk customers. On May 31st, Singapore's central bank and financial regulator issued this notice. The notice mandates crypto firms to provide additional details about their operations. This includes reporting the total value of payment transactions, the number of customer accounts, and identifying high-risk customers, among other requirements. The move by the central bank is a proactive measure to address potential risks associated with digital assets and currencies. It aims to ensure transparency and accountability within the industry. The notice applies to all crypto-related companies that have been granted exemptions to offer services in Singapore. The notice specifically focuses on reporting obligations under the exemptions regulations for companies providing crypto services in Singapore. They're also requesting additional information about cross-border money transfers, digital payment token services, and e-money services. Now, Singapore is known as one of the most crypto-friendly jurisdictions globally. Even so, they've adopted a cautious approach to regulating the crypto industry following the notable collapses in 2022. In April, they hinted at tightening regulations for stablecoins following the collapse of Terra UST more than a year ago. Now, Singapore's regulatory framework treats different types of cryptocurrencies based on their unique characteristics. Certain crypto assets are classified as capital market products, similar to securities. Others are regulated as e-money or digital payment tokens, DPTs. The central bank defines e-money as electronically stored monetary value denominated in any currency or pegged to a currency. That's important. Compare that to a digital payment token, because they're described as a digital representation of value expressed as a unit. It's not denominated in any currency, and it's not pegged to any currency. Therefore, if a crypto firm deals with DPTs or facilitates their exchange, it falls under the regulation as a DBT service provider. And that's going to do it for us tonight. I want to thank you, my listeners, because when you stop listening, I will stop talking. If you enjoyed tonight's show, then please like, follow, subscribe, leave a rating, or maybe a review. And in the meantime, we'll see you tomorrow night.